Today we're going to talk about income tax. So let's start with the definition. Income tax is a percentage of your income collected by the government to fund its services and programs. Note that there can be both federal and state income tax depending on where you live. So everybody's going to pay federal income tax, but depending on the state that you live in, you may not have to pay state income tax as well. So the states with no income tax are Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. Let's talk about income. First, let's look at gross income. Gross income is the total income for the year. So this will be not just your wages, but it's also your tips, interest from any kind of bank accounts you have, income from investments, profits from business, rental income. So any money that you're collecting, that becomes part of your gross income. Adjusted gross income is your gross income minus adjustments. So what are adjustments? Adjustments include contributions to tax-deferred savings plans, tax-deferred retirement accounts, interest paid on student loans, and alimony payments. Exemptions are standard fixed amounts that can be subtracted from your adjusted gross income based on the number of people you financially support. So two different things here of adjustments and exemptions. We also have something called deductions. So one type of deduction is called a standard deduction. It's just a lump sum amount that can be subtracted from your adjusted gross income. There's also an itemized deduction where deductions are listed separately. Deductions can include charitable contributions, interest on home mortgages, state income tax, property tax, medical expenses, but only if they are more than 7.5% of your adjusted gross income. When you go to do your deduction, you have to decide which one is more. So is it better to take the standard deduction because it's higher, or is it better to itemize because all of those items together come out higher than the standard deduction? Your taxable income is based on your gross income minus the adjustments and the exemptions that you have. Let's take some examples and see if we can really figure out how this works. So let's start with Amy. Amy earned $58,000 in wages. She received $750 in interest from savings and contributed $4,000 to a tax-deferred savings plan. She gets a personal exemption of $4,050 and has deductions totaling $3,500. So let's find Amy's gross income, then we're going to find her adjusted gross income, and finally we'll figure out her taxable income. So starting with her gross income, we take her wages, $58,000, we add the interest, $750, and we have a total of $58,750. Her adjusted gross income is the $58,750 minus the $4,000 she put into her retirement plan. So this gives us $54,750. Her taxable income takes her adjusted gross income, but then we're going to subtract the $4,050 that she gets as a personal exemption, and we will also subtract $3,500 in deduction, so we arrive at $47,200 as her taxable income. Let's take a second example. Here's Blake. Blake earned $53,400. He received $200 in interest and contributed $3,825 to a tax-deferred retirement plan. He was also entitled to a personal exemption of $4,050 and a standard deduction of $6,300. The interest of his home mortgage was $5,000. He paid $2,572 in state taxes and paid $2,500 in real estate taxes. When we get to his taxable income, we want to make sure that we base this on whichever is higher, his standard deduction or his itemized deduction. So we really, again, want to go back and start with gross income. So we take his $53,400, we add the $200 in interest, so his total is $53,600 for the year. His adjusted income is the $53,600, subtracting the $3,825 that he put into a tax-deferred retirement plan. So now his adjusted gross income is $49,775. And then to get his taxable income, let's look at the two kinds of deductions he could have. So we have a standard at $6,300, but if we add up the itemized part, $5,000, $2,572, and $2,500, it's $10,072. So this itemized deduction is higher than the standard deduction, which means he definitely wants to use this itemized amount. So when we figure out his taxable income, it'll be the $49,775 minus the 4,050, and then 10,072. So notice that when we're subtracting, we have both the exemptions and the itemized deductions that are in here. So then what his taxable income is, 35,653. The whole purposes of this is trying to reduce that amount of income, because if you make less money that they can tax, then it's less money that you have to pay. All right. So here's the marginal tax rate, and this is from the book we're using. So it's table 8.1, and it gives the 2016 marginal tax rates. So there could be newer rates since then, but this is what your homework is going to ask. So this is what I based this PowerPoint on, which of course I turned into a video. So I will keep referencing this. You can print this from the book if you want to. You can print it from your homework. It will pop up as you're doing your homework as well. So I just wanted you to see what I'm going to be basing this on. So it gives the rates. So you see the tax rates in this first column, 10, 15, 25, 28, 33, and on. And whether you're single, married, filing separately, married, filing jointly, or head of household. And it gives all the explanations. So what's happening in this tax rate is you're paying 10% for the first $9,275 you make. Then for this next bit of money, you pay 15%, and then the next bit of money, you make 25%, and then the next part of money, you make 28%, right? So based on the pieces of your income, you pay different percents, and of course, the more money you make, the more taxes you pay. So we're gonna look at an example of how we deal with this marginal tax rate. So we're gonna use the 2016 marginal tax rate to compute the tax owed by the following person: a single woman with a taxable income of $42,345. To do this, I just created a little table that broke down the tax rate that she falls into. So because she makes $42,000, I went all the way past it, so you can see the $42,000 would be between $37,000 and $91,000. So we're going to break up her income based on these percentages. So for the first $9,275, she's going to pay 10%. So all of this first amount will get the 10%. And then anything between $9,275 and $37,650 will pay 15%. So I'm subtracting this amount to find out how much money is there and how much will be taxed at 15%. And since this $42,000 is greater than this $37,000, I go into the next bracket and I again see how much money is there. So I take the $42,345, subtract $37,650, and it tells me this $4,695 will be taxed at 25%. So different amount based on the tax bracket of how much money she was in. All right, so you can see tax rates, single person, so we're using that amount, how much money it was in each amount. So what we did in the previous slide, the $9,275, $28,375, $4,695, and I want you to see this totals her annual income. And then I multiplied by the rate for each bracket. So 10%, 15%, and 25%. And then I added those amounts up, which came out to $6,357.50. As we're talking about paying taxes, there are also things called tax credits. A tax credit is a reduction of the tax you owe. The tax credit is subtracted after using the tax table to compute the tax owed. So we would go through that marginal tax analysis before we subtract the taxes. So it's different than earlier. We take the exemptions and adjustments out, and then we have the taxable amount. This is we figure out the taxes, and then we take the tax credit off. Types of tax credits, and I will make sure I post this in case you want to click on it later so that you have this PowerPoint. I went and looked at places that you could get tax credit. This is not an exhaustive list, but it's some. This gives you an idea of it could be for some child care, for care for elderly. Sometimes it depends on what state you live in, if there's some kind of rules they have there. So I just gave you a few of the ideas of what you could do to get these tax credits, but it's not exhaustive. So again, we are not trying to be like a financial course. We are a financial chapter. So I'm just giving you some overviews of things. I am not trying to say I'm not an accountant, right? I'm not a tax professional. I'm just giving you overviews. So let's take an example to figure out how the tax credit works. So Claudia is a single woman with a taxable income of $27,000, and a tax credit of $1,200. We will use the 2016 marginal tax rate to compute Claudia's tax owed. We need to start by finding the tax owed before we use the tax credit. So we'll do this just like we did in example 3 by breaking down our income. Once again, I go to the tax rates and I look at how much she made. This time she made $27,000, so I can stop at the $37,000 bracket. So the first $9,275 she makes, that whole amount is going to be taxed 10%. Then the amount she made between $9,275 and the $27,000, she's going to pay 15%. So you can see here that I've subtracted $9,275 from the $27,000 to get $17,725. So just like before, the amount, as I broke it up, will add up to $27,000, and you can see I multiplied the rate times the amount, so there's a total of $3,586.25 as her tax amount. Now this time, which is much different, this amount we are going to reduce by the $1,200 tax credit. So this whole amount, $3,586.25, I subtract the $1,200, and it says the tax owed for the year would be $2,386.25. There are more taxes that we need to talk about. So this one is called FICA. On top of income tax, employees pay into the Federal Insurance Contributions Act, FICA. This federal law requires a 6.2% Social Security tax on up to $188,500 of income, and then a 1.45% Medicare tax, which is called the regular Medicare tax, an additional 0.9% Medicare tax if you earn more than $200,000. So let's look at a chart for FICA. I broke up the chart in 3 places. So the first column says employees rate, the middle says employer, and then the last column is if you're self-employed. So the employee rates are the 7.65% and the 1.45% that we previously talked about. Then the matching, you can see they're the same numbers, 7.65%, so we put it in, also does the employer, same thing here, 1.45 and 1.45. Self-employed means you're having to pay both of these amounts. So if you added 7.65 and 7.65, you get 15.3, 1.45 and 1.45 is 2.9%. So employees get to share what they're contributing with their employer, but the self-employed, they have to pay the whole amount. Notice here it does say of net profits, so it's a little bit different than a wage. It says a profit. Totally different, not something we're going to cover. It's just something I wanted to point out in the chart. All right. So let's say Dante is not self-employed and he earned $165,000. What are his taxpayer FICA taxes? Okay. So remember our rates, 7.65 for the first $118,500 and then 1.45% for income in excess of $118,500. So we again need to separate his income based on how much money he made. So for the first $118,000 he made, he will pay 7.65%, and then anything over that, so here's why I'm subtracting $165,000 minus the $118,500, he will pay 1.45%. So I went ahead and changed this over from percents to decimals, and then I found this difference between 165 and 118. So I multiplied out these percents, and it says that his total FICA should be $9,739.50. Let's look at another example. So this is Emilio, and this time he is self-employed, so this will change the column we're looking at. He earned $192,000, and we want to look at his taxpayer FICA taxes. So now because he's self-employed, it means he has to pay 15.3 and 2.9%. So first we have to again separate his income based on the chart. So for the first $118,000, we can see there's a 15.3%, and for that second amount over $118,500, it'll be 2.9%. And again, I'm just multiplying this out, so I have 0.153 times $118,500 and plus 0.029 times $73,500 says his FICA taxes were $20,262. And I just want to say, ouch. That sounds like a lot of money. So here's our last example. Fiona gets a job as a hostess. She will earn $11 an hour and work for 24 hours per week. Her employer will withhold 10% of her gross pay for federal taxes, 7.65% for FICA taxes, and 4.5% for state taxes. So we're going to figure out her weekly gross pay, then the amount that they're going to hold for federal taxes, how much for FICA taxes, and then for state taxes. So we're going to start with her gross pay. She got $11 an hour, worked 24 hours a week, which is $264. 10% of that is going to go to federal tax, so that's going to be $26.40. And then 7.65% will go towards FICA, so I take the 264 times 0.0765, which is 20.196. Notice that this doesn't fit into our normal money, so I'm just going to round that up to 2020. Then the amount held for state tax, that's 264 times 0.045, which gave me 11.88. So let's look about this a little harder and say, well, how much money did she get at the end of all this? So we're going to look at her net pay by taking the amount she made and subtracting all the taxes. So she made $264, but then she paid $26.40, $20.20, and $11.88, which is $205.52 as her net, right? So she had the $264 she made, we took out those amounts for taxes, and it says she ended up with $205.52. So the last thing we're going to look at is what percent of her pay was withheld for taxes. To get the percentage, we don't have to do anything fancy. We just go and say, well, what were the little percents all together? So we had 10%, we had 7.65%, and we had a 4.5%, which says in total, 22.15% of her pay went towards taxes.